Prathamesh sir,
Yes, sir. Should
I
we
think
start?
we should start, sir.
Okay, okay. Sure, sir. Sure, sir.
It's already two
Yeah.
o'clock, and everyone has scheduled. We don't want
Yes,
to
yes.
waste
Sure,
Prasad
sure,
sir's
sir.
time.
Yeah, sure, sir. Sure, sir. Okay, yeah. Good afternoon, everyone. Good afternoon, Prasad, sir. So we welcome you on the behalf of JSPM College. And to the all students, we are pleased to welcome CA Prasad Vatankur, sir. He is a chartered accountant and finance professional from Pune. And he is the today's speaker on angel investment with rich experience in taxation, audits, transfer pricing, and financial reporting, coupled with deep insight into investment strategies, portfolio analysis, and wealth management. He is known for simplifying complex financial concepts and bringing real-world perspectives. Today, he will share his expertise on the opportunities and practical aspects of angel investment. So, I would now request Prasad sir to give us insights on investing.
Thank you so much, Prathamesh. It was really a great introduction from your side. So, good afternoon, everyone. Myself, CA Prasad Vadharkar, and uh, initially, I would like to thank Dr. Dipali Sharma, Dipali Surana, sorry, Dr. Ameya Chaudhary, and Dr. S.G. Argade sir for inviting me to this session. So I'm really looking forward to have really great time with you all and try to share as much as knowledge I have regarding this subject. So can I share my screen?
Hey, yes, sir.
Okay. Is my screen visible to you all?
Yes, sir. It is visible.
Okay. So today our topic is angel investing. So a lot of time what happens is we see a lot of different startups in different various industries, and to grow, to move ahead, or to become a unicorn, which is a benchmark setup for different startups, there has to be a funding. There has to be somebody who invest into that startup or provide that initial as well as intermediate and the final capital investment to particular startup. So normally what happens is there are different stages at which a particular startup goes through, and we are going to look at that those stages later in this presentation. So let's begin with the kind of investing styles or different strategies different investors has when it comes to investing into particular startup. So first ideology is value investing. Particularly an investor in value investing, what he does is he just buys the undervalued stocks and look at the growth trajectory a particular industry or particular company has, and he just invest into that and just try to get the maximum alpha. Alpha is like what you get over and above your cost, that is called as alpha. He tries to maximize the alpha into particular investment, that is called as value investing, under buying undervalued stock. The next style of investing is growth investing. Now there are different companies like Geo or Facebook or take for that instance the Google. They have huge growth potential. Now even the OpenAI also has joined the group because these all these different sectors are emerging, and we really don't know what will happen in these sectors. Now these AI and machine learning is at really an early stage. So these investor, they actually make due diligence of these companies and try to estimate what kind of growth trajectories these companies will have. They will have the presentation, and on the basis of that they invest into these high growth companies that gives them maximum amount of returns out of it. Now next investing style is income. There are different types of companies who distribute their income to investor. The first type is paying back the dividend to the investor. Second is second is that when the company performs really well over the period of times, the stock price of that particular company shoots up, and when investor sells those shares, he gets the kind of cash flow or return on investment he wants to get out of the stock. So these investors, what they do is they actually do the due diligence and try to find out different companies who have maximum dividend payout, so that in spite of not selling those investment into those companies, they will still have some cash flow out of it. So that is the kind of ideology behind income investing. Now second is, a lot of before before 2000, there was different ideologies of these investors while looking at company. After 2000 and 2010, after looking at the kind of impact these companies, manufacturing companies, textile companies, or different industries had on the environment, now the lookout these investors are having in by looking at these companies have changed. Recently, newer concepts have been introduced, such as ESGs, that is environmental, social, and governance. Now, these investors have also started looking beyond the top line and bottom line. Top line is sales, and bottom line is profit. So, beyond that, they have also started looking at what kind of impact these companies really have on environment. So that is called as impact investing. So they go through this performance of these companies and analyze whether these companies are really having a huge negative impact on environment or what. Because going forward in long run, those companies who are carbon efficient only will be able to grow at largest pace, because there are different governments who are putting a lot of restrictions upon those industries, those companies who are uh, providing hazard to our nature. So eventually they will be put in with a lot of restrictions in order to not let those companies get affected by those regulations. These investors have started changing their ideologies and going towards carbon neutral companies while investing their corpus. Now another style is venture capitalism. So what are venture capitalists? These are big firms, which are corporate firms. A lot of different big investors actually form these firms and invest into those companies who are at mature stage, rather than being at initial stage, because these companies have attained a particular turnover, particular scale, and they have proven themselves into the market. Now these investors put in more funding into those companies, and they take that scale to a different level. Now if you look at Google, Facebook, or Microsoft, they have huge scale. So when they have this graph, at initial stage, this angel investors comes into the picture and help that particular organization to go from the initial startup phase to a mid-level entity. And after that, the venture capitalists, they come into the picture, and then they take that company into a different level altogether. Those are venture capitalists. Now, the topic we are discussing today, that is angel investing. So, what this angel investor does? So, let us understand that in the next slide. So, what is angel investing? Angel investors are those individuals who have high net worth. That means they have already been into businesses for years. They have successfully built some businesses. Now they have some excess cash which they want to invest into such companies which they're aware about, the kind of industries in which they have their expertise, and they know those industries in and out. Now they want to invest in those startups and get maximum return. That is so these are high net worth individuals. Now when they invest into these companies, what they will get in return, that is a percentage of that company, that is equity. And another thing is convertible debt. What is convertible debt? When these investors pay the particular amount of money to those companies, they issue a debt certificate to these investors initially for a particular time of span as agreed by them in the agreement. They will get fixed return out of that investment, and after particular amount of time, let's say 10 or 20 years, these convertible debts are converted into equity, and then these angel investors get the share of that company in the form of equity. So this is what they get back when they invest into particular company. Now, angel investors has something very special. That is, they don't just pump in the kind of capital into the particular company, but they also provide different services such as mentorship. These people have already proven their skill set, already understood the market, the psychology of customers, and they have actually understood what the customer needs. That is exactly what a startup entrepreneur who is starting his startup needs, because there are different business cycles under which we really don't know, that entrepreneur really don't know what kind of action to be taken at that particular time. In that case, these angel investors also provide them financial aid and also give them guidance about what kind of plan of action they should take at that particular time, and help them to get off that crucial situation. That is mentorship. Second is, they have lot of different industry connections. They have already been into business for so long, so they have built those connections, and they also help these young entrepreneurs to connect with those people, and that facilitates the young entrepreneurs businesses. Again, when a particular entrepreneur starts a startup, initially the capital is bootstrap or seed funding. What is bootstrapping means putting the kind of saving you have had till now into particular startup. And second is seed funding. Seed funding is getting capital from your friends and family and putting it into the startup. So these are primary sources of capital at the early stage. After that, there was a gap between this early stage and latter stage, that is venture capital, because after attaining particular scale of that business, there was a lack, there was a gap wherein these entrepreneurs would not get the required capital, because this venture capital firm needs a particular business to prove it itself in the market, that and then these venture capital firms comes into picture, and then they invest. So there was a gap between these both stages, which is filled by these angel investors. So they help these organizations at an early stage, not an early stage, but after there are different stages, such as there is idea, then you have proof of concept, then you go into product development, then you go after product development, you start your first commercial transaction, that is getting different customers. Then there are different stages, and at the end there is IPO, initial public offer, wherein you must have heard about different companies having their IPOs on national stock exchange. Then public will come into the picture at large. Before that, all this venture capital and then angel investor comes into picture, and then latter part, the IPO happens and public invest into particular company. Now Reliance, Infosys, and then TCS, they all are listed companies. So before that, there was this gap which was filled by these angel investors. Now let's go to the next slide. Now in angel investing also, there are different types of angel investors. First is individual angel investors. Now these are solo angel investors. They have expertise in particular domain, and they stick to that particular domain, because to start a particular business and to get the industry expertise, in itself is a difficult task. So not everybody can really get expertise of different various industries. So this what this individual angel investor tries is, they try to remain in the same industry, find those newer companies, emerging companies in the similar industries, and then they invest into those startups. Now these angel groups, what are angel groups? Angel groups include a combination of different individual angel investors. So there are, suppose there are 5 different industries in which this angel group wants to invest. So they go to different individual angel investors who are really expert in those industry. They bring them into their panel, and with the help of them, they invest into various industries. That is angel groups. Now these corporate angels, you must have heard about the Zomato acquired Blinkit. So what happened. This is kind of merger, or this kind of acquisition happened because Zomato realized that over the period of time that the Blinkit will be a great competitor for them going forward few years down the line. So they realized that, and what they did was initially, like this is an example. What these big corporates do is they invest into small startups in the similar vertical, that is similar industry. They invest into similar industry. They find those startups which might be a great competitor for them going forward 5 years or 10 years down the line. So to cut short or to destroy that competitor, they invest into the startups and make that startup part of their ecosystem. That is corporate angels. So they invest through this style of angel investing. Now these serial angel investors. Now what happens is, a particular angel investors invest into various different multiple startups as well as multiple industries or business verticals. So what so while doing that, angel investors do not just stop by investing into particular startup, but they have this series of rounds. You must have heard about startup going for a series A, series B, series D, and different series of rounds. So that is a part of venture capital ecosystem, but similar